Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Today, we have one of my all-time favorite guests back on the show. We're joined by Antti, Ilmanen, global co-head of the Portfolio Solutions Group at AQR. Capital management in this role, he managed the team responsible for advising institutional investors, sovereign wealth funds, that means big money, y'all, develops the firm's broad investing ideas. He has a new series of papers this year. I'd like to call it a book almost. They're almost about expected returns. We're going to cover them all today. Antti, welcome back to the show.
Thanks. Great to be back, Meb. And yeah, it may even convert into a book next year. There's some talk with CFA Institute. Yeah.
Well, I wanted to ask you a question. You know, when you join AQR, is the first week, do they say, look, here's the deal. We got to make sure you do a class in footnotes, because the AQR papers always have the best footnotes. And I actually tweeted one last night that there was a quote that you put in near the end of the first paper. And I'm going to read it, listeners, because it was so good. You can tell me why you chose to include this, from G.K. Chesterton via Peter Bernstein. It says, quote, "The real trouble with this world of ours is not that it's an unreasonable world, nor even that it is a reasonable one. The commonest kind of trouble is that it is nearly reasonable, but not quite. Life is not an illogicality, yet it is a trap for logicians. It looks just a little more mathematical and regular than it is. Its exactitude is obvious, but its inexactitude is hidden. Its wildness lies in wait." Whew, that was a mouthful. Antti, why'd you include that one?
Yeah, well, first, overall with footnotes, I love them as much as Cliff. And there's something about, the honesty of it, that like when there are qualifiers, we sort of feel bad not mentioning them. And then sometimes there are extra stories which sort of work better as detours. And that one was sort of a funny thing to put into a footnote then, but it's a beautiful idea. And I guess one theme in it is the humility that we really must have when we are trying to forecast markets. And so that's probably the key reason.
We'll include this cartoon in the YouTube video, listeners, but it's a picture of a guy driving. It's a black and white cartoon. And instead of sunglasses, he's wearing the rear view mirror from a car. And the point of this is, we can kind of start off with the first paper, is Antti kicks it off on this very fundamental question, which is, how do people come up with expectations of what their investments are going to do? And maybe break it down for us into the two camps, the difference between kind of the objective yield-based ideas and the subjective rear view mirror. And love to hear kind of how you distinguish between the two, and we can get into who's better.
Sure. And yeah, so in some way the starting point is this worry about this rear view mirror mindset. And I think it's been maybe always there, but it certainly has become worse with attention spans getting shorter, memories shorter. And now we've got this world where most young investors lived only in this post-GFC era where risk-taking has been superbly rewarded, especially in US and tech and so on. And I think that's a misleading rear view mirror. So I try to highlight both the role of looking at longer histories and then looking at forward-looking measures, which often can tell the opposite view to that rear view mirror. And so that's sort of part one. And then the second thing really was that I wanted to bring in this contrast of objective and subjective expectations. And I'll explain it. So simply, subjective expectations are what we really hear from the horse's mouth, from investor surveys or analyst surveys and so on. And they have become increasingly useful and used sources of information. But so first, objective expected returns, they are pretty much what I've been talking about in my writing, what people talk when they talk about capital market assumptions. Largely, it's basically the kind of expected returns that are reasonable to have from rational perspective. They should be something that has got ability to predict future returns. Market yields do tend to do that, even if they sometimes fail miserably, and we've seen quite a bit of that in the last last 15 years. But the basic idea with objective expected returns is that if you have got high starting yields, which means low valuations, then that predicts higher long-run returns. And subjective expectations can behave in almost the opposite way. They extrapolate past decade growth, for example, or returns. And that's why we call it sort of rear view mirror mindset with those subjective expected returns. And so they can be especially bullish when valuations are high and starting yields low. And we saw that in 2000, we saw it in 21, might be seeing it now. And again, it's not everybody has got those subjective expectations. We'll talk about that then, like who would have those extrapolative expectations as opposed to somewhat more contrarian mindset.
Everyone in our head, we've read Stocks for the Long Run, great book, Jeremy Siegel, others, and everyone gets in their head, okay, stocks are going to do 10% a year or whatever the number is. And reality is we all kind of extrapolate from our own lived experience. And the challenge in our world is that these regimes, and so we're in one right now where US stocks have done 15% a year for 15 years. That's a career for most of us. I can't even do the math on 15 years from now. How old am I going to be? But it's a long time. And so talk to us a little bit about, so this chart, we can start to talk about valuations on the yield-based and return-based, but maybe talk to us a little bit about how you put your thumb in the wind and who picks a side on these.
Yeah, well, maybe first I just say that I think it's a bit of a Rorschach test on how you care about long-run history at all. So many people just say that, last 10 years is all I know about, but even if I know about some longer history, I think the world has changed. And then nothing we show from the last 30, 50, 100 years or so on matters to them. And I think that's a dangerous but common mindset with many. So what we do early in this series is to contrast the yield-based estimates, such as inversion CAPE ratio, predicting future returns, and it's got 0.5 correlation or something like that. So it's pretty decent looking at longer horizons, but it also sucked quite a bit, and we'll return to that. But it sucked in the last decade, especially for US. But it's still, if you look at the long-run data, it's better to have 0.5 positive correlation than what we see if you look at the rear view mirror, where it's minus 0.3 correlation, looking at last decade's returns versus next decade returns. So there is medium-term mean reversion there in returns, and rear view mirror is really poison if that keeps happening.
The assumption, and you can talk to us a little bit about this, is that the institutions tend to base their judgments off sort of a yield objective based idea, and retail is just on how returns have been. Is that a good summary, or is that maybe a little more nuanced than that?
Yeah, well, there are some more nuances, but that's a very good broad brush. So investors in general, they are heterogeneous within groups, certainly, but between groups, I think we can say what you said, that retail has got this extrapolation bias looking at the rear view mirror. And then when we look at institutions, especially their capital market assumptions, it seems that those capital market assumptions pretty much move along with this objective yield-based expected returns. That said, I think there are cases where those institutions may not quite act, they may not follow their capital market assumptions. For example, any capital market assumption based on these types of estimates would tend to say that you should have lower expected returns on US. Many institutions didn't do that, and they pat themselves on the shoulder for staying at least market weight with the US, and in some way good for them with hindsight, even though it was inconsistent with what they put on paper. But I think, again, in the long run, I think that they probably will do disservice if they, bail out from using these types of yield-based estimates, because they are useful. They just didn't turn out to be useful in the case of US equities in the last decade.
The challenge, and this is why we think it's so important to be a student of history, and you hit the nail on the head with the US, is you go back far enough, and the conclusion you would derive from various points in history, right? If you were invested, 1600s, 1700s, you would say the only place to invest is Amsterdam or London. US didn't exist yet. And then maybe in the 1800s, like the blue chip is UK, or you could do on and on and on, right? And the lived experience of people in Austria versus, say, South Africa, Australia versus Argentina. You come to very different conclusions if you try to extrapolate from just one country. And the struggle I think everyone listening to this right now is, most of our listeners are in the US. You're in Finland right now today, so you got a little bit of a global perspective. But I feel like a lot of people have looked at this particular bull run, and when it comes to the rear view mirror, have said, yeah, but this is the only game in town. This is the way it's going to be. Talk to us a little bit about, is this particularly a challenging point in time? How do we think about these two conflicting kind of ideas?
Yeah, well, you had a lot there, and again, when you look at overall, by the way, equity markets, and in like 1800s there was no equity premium or very very little, and then with hindsight we know that 1900s used to be great. 2000 there's been very little equity versus bond premium, but again, US somehow again we could cherry pick these stories so that rear view mirror really has served investors sometime quite poorly. But this has been a special case where it has worked well. And in the background, there is this whole idea that with the rear view mirror, and I'll come back to the US argument in a moment, but I'll just make a more generic point here, which is that we think that some extrapolation makes sense because trend and momentum tend to work, but that's just for the next year. If we talk of 10 years, there's been more mean reversion tendencies in long run data, and sort of like that should be the base case. So when people extrapolate more than they should, which is sort of over extrapolation, that means that they are assuming more persistence in growth or in, let's say, so this would be earnings growth or in returns than is realistic. So, for example, we do tend to find that abnormal growth is, works for a couple of years, but many people tend to think that it's there for 5 or 10 years. And now that we have got some cases like Amazon, Apple, Alphabet, where that worked out, then they think that, this is the way to go, and again, ignore longer term lessons. Anyway, I would say that there's a really good long run case for arguing that the US has got something exceptional, but that has been taken way too far in this last 10 years because we had exceptionally benign environment for US. So if I put some numbers here, in the long run, we see that US has outgrown. So earnings per share growth has been about 1% higher than the rest of the world. And that's good. And I think we can go into why US exceptionalism is there, but that seems to be like there's a rational basis for it. But if you only look at data post GFC, the number is closer to 3%. And that's what many people have in mind. And they think that this is sort of the new normal where we'll stay. And that's a very, it sounds, why not 3%? But has not happened historically over very long periods, and I don't think it is likely. And the fact that then people have taken this mindset that there's going to be this much bigger growth edge for US than before has pushed US relative valuations higher. So now if I go for a moment to the CAPE ratios, but in a relative sense. Let's look at US CAPE over the largest non-US markets.
And Colby, you can pull up chart 1.3 has got a good chart that just shows the US weight relative to the US versus non-US CAPE valuation.
The bluish, light blue line there shows this relative valuation or valuation ratio, CAPE ratio, US, non-US. And you can see on the left axis that it hovered around one sort of similar valuations from mid-90s to GFC. But then US took off and we reached almost 2 last December, and we are still, 1.8ish or something like that. So we are at very, very high levels. So US has got almost double the valuations than the rest of the world. And again, I argue that that's because the growth expectations are sort of taken with the narrow window of the post-GFC experience. And really, that's big enough story to come back to later. But at this point, I would say that, hey, let's also look back before that 2000-ish period. Let's look at 1990. US valuations were half the rest of the world. And that, of course, was the time of the Nikkei bubble when Japanese equity markets were very large part of non-US and very, very expensive. And it turns out that if you look at how well this ratio predicts future returns, it predicted very well things, including basically predicting non-US underperformance from those rich levels when the valuations were double the US at that point. And it was very good track record up to GFC. And since then, US has gone on this path of double valuations, and we haven't seen that correction yet. And I do say yet because I do think that some amount of correction will happen. So I would like investors to think that, yes, US probably has got a growth advantage, but now we are pricing such a big growth advantage that with these almost double valuations, we are basically putting US equities, giving US equities the biggest weight historically, or close to 70%, just at the time when US is, relatively speaking, at its most expensive. Sounds dangerous to me.
You guys heard it here first. Antti is joining Kiyosaki and Harry Dent saying a giant crash is coming. I'm just kidding. I'm not putting words in your mouth, but you know, it's funny. You got another chart that's good. This is 2.1. A lot of people, and you've kind of laced this in so far, where people say, yeah, Meb, Antti, but the U.S. has had much better growth. That's been the driver of what's happened here, you know, and you have this nice chart where you're like, well, look, actually, a big part of this re-rating of the past 40 years has been the U.S. going from really cheap, you know, to a much higher level, and foreign doing the opposite.
Indeed. So on the left-hand side, we just have got this raw data separately for US and non-US on returns and growth cumulatively. But let's look at the right-hand side where we show overall this relative performance, where you can see that, yes, US has outperformed post-GFC, pretty much one-way street, but it's nice to remember that in 2000 to 2009, US underperformed. So it did in 1980s, by the way, so it did in 1970s. So let's not think that US has got a God-given right to outperform always. But even if you focus on this post-GFC era where US has consistently outperformed, it is interesting to ask, did it come from richening or relative growth? And this picture shows that it was more the richening. Both contributed, but there was more coming from the richening. And especially from today's perspective, when you look at this long, I don't know, the thing that people remember, it really has been primarily from that richening. And I do think that the richening has got a fundamental story, which I was talking about, that US has had the growth edge, which has then optimistically repriced to stay with us until kingdom come. And that's where I think the danger lies now.
And chart 5.1 is another extension of this. And I feel like you're going to get some people riled up over on, I don't know, Bogleheads or Reddit or Twitter or something. And the title of these two charts, listeners, if you're listening to this on podcast, I definitely would hop over to YouTube because these are some amazing charts. I'm going to just read the title of these charts. It's like major drivers of equity market returns. And the first one is valuation changes drive decadal market returns, and then earnings growth matter less. I feel like you're gonna stir up a hornet's nest here, Antti. Tell us about these two charts, and these go back to 1880.
Yeah. So we flip a little back and forth. Look, earlier we were just looking at US versus non-US relative performance. Now in some papers, I really just go back and look at S&P 500 from the perspective of historical returns and its drivers, separately looking at these CAPE type of valuation ratios, and then these forward-looking metrics. So I get like a triplet of papers, really purely looking at US standalone. This is S&P performance on a 10-year rolling basis, and we can see that there is a nice 0.9 correlation between 10-year real returns and 10-year valuation changes. So that's the contemporaneously key driver when we look what's moving the market. And again, that's what has, by the way, happened now after GFC when these types of CAPE ratios have been very poor predictors, because we got this richening from pretty average levels of the market to almost all-time highs, now CAPE ratio being 40. And that type of richening does boost returns nicely, both in an absolute sense that we look at here and in a relative sense versus other markets. And then in the lower panel, we just look at, again, compare 10-year returns to earnings growth And those correlations are tiny compared to what we just saw with the valuation changes.
There's another one, 6.4. And, talking about valuation, the whole key to this, Antti, is you just got to tell us where the valuation is going to be in 10 years. That's the key, right? We understand valuation is a massive driver. It's either a huge headwind, huge tailwind, can be 5, 6, 7 percentage points per year difference, but you just got to know where it's going to go. Is there any useful kind of rules of thumb or how to think about, where it might be in 10 years from now?
Yeah, well, let's say, so if you look at historical data, you should bet a little bit towards mean reversion, like Rafi and GMO do, and shows up in 100 years of data that there is some of that. However, if there's a structural change, you'll be looking pretty silly there. And so we've chosen basically not to add this mean reverting valuation, but I don't think anybody has really, certainly from systematic perspective, I think most observers would assume somehow lower valuations from here, rather than thinking that CAPE ratio in US would go from 40 to 50 or 60. Again, maybe if you really assume some, those to me nutty sounding numbers on what kind of growth levels AI could generate, then we could get some really unprecedented valuations. But to me, again, when we are at all-time highs, we shouldn't really assume more. But just on this picture, and the story here is that when you look at the full history of more than 100 years, you do see a pattern that high valuations tend to predict lower returns. But it's a pretty noisy relationship, and R squared 26%, which means roughly 0.5 correlation. Then if you only start in 1980s, there's 85% R squared, very tight relation there. And that the beauty of starting in late 1980s is that you omit the structural change that happened to CAPE in 80s, 90s. So there is this is sort of this is the honest sort of two-handed economist here now telling that while this is a good indicator, there's a real danger if there's a structural change. And what happened somewhere in 80s, 90s was that CAPE ratio went from average 15-ish to average 25 plus, and where we have been in this century. And so if you knew it in advance that there would be that type of richening, then you wouldn't have waited for mean reversion for CAPE to come back to 15. But if you were sort of acting real time as an investor who was observing these things, you would have been unnecessarily bearish for US equities through much of last 30 plus years. And so we've just chosen to be humble in the sense of not assuming mean reversion when we are making our forecast, because we can get those structural changes. And we think that you get already the cautious message on expected returns when starting valuations are high, which means starting yields are low. Then even without mean reversion, you should be expecting less than what has happened. And that can only be offset by extra fast earnings growth or richening over the next decade. And we did get those things now in the post-GFC era. And people are sort of taking that as a message that, that will continue forever. And that's, I think, a very bad rear view mirror lesson that people may be taking.
People love to say, yeah, Meb, Antti, the challenge with valuation is even though we're quants in in this high frequency world, when you're talking about valuations in a 10-year period, we actually don't have that much history. The good news is you can add in foreign markets, but they kind of overlap a little bit. Norbert Keimling from Taunus Trust over in Europe has a nice chart we'll post online where he kind of does the scatter plot that Antti does, but with some foreign countries. And you see the same general trend overall. And I think a lot of the confusion comes in the struggle for many investors is they kind of get the diagnosis, right? They say, Antti, Meb, I hear what you're saying. I know US stocks are expensive at a 40-time PE, but then it's like what is the prescription? What do I do about it? And I think the wrong thing to do about it that so many people want to think I got to sell all my stocks, right? Or I got to think in binary terms. I got to get out. I got to, these things going to crash. And there's a lot of ways to, I think, kind of mindset think about this. The first one being probably just don't expect 15% returns forever to the moon. Like that's like get your expectations kind of, a little more mellow.
I was a young student then in Chicago in 1990s, and then basically early in my career through the decade of pretty bullish 1990s. And I already learned that CAPE ratio didn't exist really. It was published in research in 1996 or so. But before that, dividend yields were typically the market timing signals that were used, and they were at all-time lows. And it just seemed that, okay, from valuation perspective, you really don't want to be in this market. And I basically, with my little money in the 1990s, I stayed out of the market through the decade. And by the way, I'm pretty glad that my big investments I made 2008. So at least I did some parts of the contrarian timing right then.
I like to point out, by the way, 2008, 2009 CAPE ratio was low teens. People are always saying, hey, it may not ever revert. It's always high. I'm like, you guys, not that long ago, it was pretty cheap. All right, keep going.
Had a fleeting moment. Yeah. But so my office mate at Salomon Brothers and a friend, Ray Ivanovsky, asked me later that, Antti, he remembers my bearishness there. And isn't it really that you believed more in your value-based market timing models than in the equity premium? And that sort of made me, because I do know that any market timing model has got limitations. And when you just use one signal in it, you should be quite humble, and then somehow trusting more, staying fully in cash as I did, or bonds, let's say, in those decades, in those years in 1990s. That was really, I don't know, misreading or misthinking the relative weight that I should give to equity premium versus some timing model. So in the spirit that you are saying, we are somehow trying to tell two stories here. We are trying to tell that there is something useful in these things, that don't throw them away, especially if throwing them away means that you are just going to do even more this rear view mirror of last decade or so on, because that's just has not been a great idea in the long run. But let's not also think that this is somehow a very robust market timing signal or country allocation signal or so on. It is useful, but it has got these limitations. So we're somehow balancing between this saying, do think of its use, but don't act aggressively. Maybe in general don't do much, and if you do much ever, do it only at very extreme levels. Like Cliff says that you have to be at 125th percentile, which is a joke because you can't go over 100. But you have to go to some unprecedented levels on any kind of value signal. And I have got somewhere in my books, by the way, I have got this little sentence or two saying that with any value signal, when you're thinking of acting, well, why don't you just close your eyes for 6 months, or basically don't act for 6 months and act then, because almost always the rich things keep getting richer or cheap things getting cheaper, and you are better off waiting.
That's good advice for almost everything in life. We did a different experiment a handful of years ago, and this was in a post that we did on a blog called, everyone was saying stocks are allowed to be pricier because bond yields were zero. And we kind of walked through some different ideas, but one of which we said, let's reverse engineer what were the starting conditions for the best returning stock periods and the worst. So like, what did things look like at the beginning and the end? And so, this going back 100 years or so. And so looking for 10 years of real returns where they did 15% per year. So kind of, these are real. And then the worst were negative, barely like minus 1% real. But the starting CAPE ratio for the great periods was around 11. And the starting period CAPE ratio for the worst stock return periods was 22. And you kind of probably know where this is going. By the end of the decade, they had reversed. It went from 11 to 22 and then 22 to 11. But that difference caused 7 percentage points of return per year in either direction. So meaning it was a massive difference, but also interesting. And this goes back to your earlier point about trailing returns. The trailing returns before the good periods were bad, and the trailing returns before the bad periods were good. And, and so you can it's kind of all the same thing, right? It's like the simplest way to come after this is just probably to be like, well, good times follow the bad on average, but not, and vice versa,
Yeah. And you just told sort of the statistics, and I'll just add the anecdote, like we are always behind the or in the storytelling front, like we tell too much statistics and too few. The one story or the one thing that people do remember is the post-GFC performance of US equities. And any sort of forward-looking measure, like you take inverse of CAPE ratio. So that was telling something like you should expect 3% real. And then there was 12, 13% or 15, whatever. Like, well, I think real, maybe 12, 13. Okay. So why did that happen? And you said 7% in your example. Turns out that it is pretty much, it was 7% per year that US equities benefited from this richening of CAPE. And that is something that we really only know with hindsight. And then we sort of get stuck with that hindsight, and we think, it's not nice. Sometimes I got my problems with Nassim Taleb, but he had some great things in Fooled by Randomness, and this idea how we go with hindsight, that when something has happened, then we start to think that, oh yeah, we should have seen it. Well, actually we saw it. Yeah, we really did know it, and anybody who didn't is a fool. And so that type of thing makes you think that the world is more predictable than it is, and you draw all kinds of wrong lessons. And yeah, that's the danger with the rear view mirror.
Talk to me a little bit about how you guys think about sentiment, and, particularly at the peaks and bottoms, sentiment is often, pretty clear in the inverse, but the problem is often, in the interim, it can always go higher, always go lower, and you never know how do you guys think about sentiment? Because you include a lot of really cool studies and analysis of surveys and confidence and how people tend to think about markets in general. What do you think?
I don't know if you'd have the very first picture there. I think it's just good to think of the equity analysts' growth expectations. Green line shows basically inverse of CAPE ratio as expected return, objective expected return, very low. When valuations are high in 2020 or 2021, you have low expected returns. But just at those times, so sentiment was high. We can see it in many ways, but especially we can see it in equity analyst growth forecasts. So they were super bullish then. And in those situations, and again, they've been bullish in the last year or so. And so I think the causality of high valuations probably goes most naturally by thinking of this strong sentiment, including basically analyst growth optimism being exceptionally high in certain times, and that pushes valuations to extreme levels. And then it's just very hard to meet those growth forecasts, and the valuations have to sort of normalize. And that's what we've seen in those extreme times. But so I sort of love in this picture this contrast between what subjective and objective expectations can be. And there could be some other sentiment metrics which tend to be highest in those bullish environments then. And vice versa, of course, very low sentiment in times like 2008, 2009, which you see there in the middle, the GFC episode.
And you also mentioned that sometimes the institutions, do they kind of get it right on their sentiment, or are they just grumpy, or like how to think about the institutions in general?
Yeah, again, they act more like the green line on paper at least. And again, heterogeneity there and so on. But there are also criticisms that institutions may be pro-cyclic sometime. And again, sometimes it pays off. It has paid off for anybody who's stuck with the US market weights in the last decade. But generally, institutions like to look at themselves in the mirror and see in the mirror a market stabilizing, contrarian, patient investor, rather than somebody who is chasing past returns. That sort of seems embarrassing to them, and yet they do a little bit of that as well, but less than the retail. Basically, analyst forecasts, they I just summarize them often that they are over extrapolative, which is what we see here, that they are basically after a bullish decade like 1990s or 2010s, they are extra bullish. And they, by the way, they predict with a negative 0.5 correlation next decade growth. So they really are not a good prediction, something useful to sort of follow when you are trying to think what's going to happen ahead. But apart from that over extrapolation that we see, there's also the over optimism. You can see basically these are real estimates. They are always here above, or let's say between 8 and 20%. And in nominal terms, they are always basically in double digits. And in reality, you don't get, the average number is something like 7% arithmetic nominal growth for EPS in the long run. So always being above that is somehow telling of this over-optimism. And it's sort of lovely when you drill into it, you find that, yeah, they really like with these are like 3 to 5 year forecasts on EPS growth. If you look at shorter horizons, you still get this over-optimism pretty much always there. Only when you get really close to the earnings announcement date, this optimism decays, and by the time there's an earnings announcement date, there's actually a small pessimism because company managements need beatable estimates. So these analysts who have got incentive to be in the good books of CFOs and CIOs so that they get access to them and so on, they want to make those guys happy by giving them over-optimistic earnings growth forecasts over longer horizons and then walking down the sort of the earnings guidance path to somewhat pessimistic side by the time of the announcement so that companies can surprise. So it's somehow telling that in some way the game is rigged. There is information in these earnings forecasts, but there's so much funny things happening because of analyst incentives. I do think that the over-optimism is the weirder thing, but the over-extrapolation is a broader human thing that we just do tend to do it. It's sort of whatever coming from the savannah times.
Can't help ourselves, man.
Yeah, that's it.
There's a slight curiosity to me, which is the bond investors think a little different, which you talk about in here. Is this because they're just, sitting there in the, with their spectacles and, bond charts and, they're much better at accounting and math, but they tend to, the whole worldview is different. You talk a little bit about this. Maybe tell us what the story is there.
Actually, in the whole series, which is sort of a summary of lots of interesting research, some of our own and some others, I think this story I have here is the most original new thing that I present here. And it is basically, in one liner, we've shown here that many equity investors and analysts are extrapolative, and we see something very different, more a contrarian pattern in bond investors. And I'll just tell first how it came about, because this is also the first finding, first evidences should be familiar for people who were around in 2010s looking at markets. There are many pictures, and I'm sure I got something there, which show that either market forwards or economist expectations on interest rates have this funny pattern that when yields were falling for 20 years between 2000 and 2020, 21 actually, there was just this always expectation of rising rates. So we were, I don't know, sadly laughing at the economists or markets that were always persistently making this wrong forecast of normalization. And so that's sort of some evidence of mean reversion there. But there's new academic research which says that, no, when the world gives you the kind of pattern that we got in recent decades, that first yields were rising from 60s to 80s to double-digit levels, and then coming back and going to all-time new lows and even to negative real or nominal levels in many cases. Those types of persistent structural changes, they are impossible to forecast real time. It is a rational thing to assume mean reversion normalization when that happens. And if those surprises just keep coming one way, then you will look foolish, exposed. And that's what happened until 22, of course, when things normalized. And what I've done actually then in 3.1, where you can see, if you just focus on the example on 10-year yields, the top picture, the lower picture on bills is similar. And I show somewhere else in the series, I show yield curve behavior rather than consensus forecast. So market. So basically the one line there is 10-year yield history at the top. And then there are these hairs, which are basically consensus forecasts for the next few years, 1 year apart shown. And you can see that most of the time they were upward sloping. Markets were expecting rising yields, even though yields just kept falling. But then I've deliberately marked in red whenever the economists were expecting falling rates. And then it's interesting to see that those cyclical sort of monetary policy cycle forecasts were pretty smart. They were always predicting falling rates when we were at temporary highs, and they were predicting rising rates when we were at temporary lows. So from cyclical perspective, those forecasts were not at all bad. They were predicting mean reversion, which tended to happen. However, there was this long-run persistent trend lower until 22, which they didn't predict. And I would say nobody probably could predict it. It was a true surprise then. And so again, that's telling that those forecasters were not so bad. And it also tells that they were contrarian minded. And again, then there is this, that leads us to this question: why do we see bond investors and bond and economists, rates economists, as mean reverting oriented, and equity investors, equity analysts, extrapolators, rear view mirror oriented? And one way I tried to answer that was looking at, is that what we see with 100 years of data or something like that? But we don't. We see, if anything, we see opposite, that in the bond side, there is some continuation pattern, and in equities, there is mean reversion pattern when you look at 5 to 10 year moves. So that isn't it? I have got a much simpler story, which is that we bond people, I'm an old bond guy, so we tend to think through yields, and yields are naturally forward-looking. We talk yields, we quote, and that gives us sort of the contrarian flavor. We don't get excited if there's been a 10-year bull market and yields are at all-time lows, whereas equity investors do pretty much the opposite. Because they quote prices and talk about past returns and so on, they get excited when we have had some really good history there. And it's different way of quoting things, talking about markets in terms of forward-looking yields or backward-looking performance has influenced even the mindset of expectations formation. So that's sort of, I think, a cool story.
This is such a fundamentally fascinating example of how narratives play out in markets, where just because bond investors think in terms of yield, and yield, to be clear, in bonds is a pretty good indicator of what you're going to get, at least on a nominal basis. But I wonder how much different the behavior of stock investors would be if they were presented, in terms of yield, right? They're like, all right, here's your earnings yield, would you behave totally different? And I imagine people would, right? But they don't think in terms of yield. They think in terms of Dow 30,000 points or whatever it is. And it's a totally different mindset.
Yeah, I emphasize this one, but there's a subtly different version of the story, which is to say that, again, bonds are they are very well anchored. Like you said, the yields are pretty good predictors of what's going to happen. Whereas with equities, in some way, you can say sky is the limit, that the growth story can always be better and the repricing thing can be however big again. So people can get more excitable in equities, and there's some justification from the equity math compared to the more boring or rational bond math. So again, both of these stories, I think, somehow explain then why we see these contrasting behaviors.
I was talking on socials a couple of years ago where I said, what's fascinating to me on the sentiment side? And I said, look, a lot of bond investors, particularly if you're invested in long bond, like you probably had a 50% drawdown and on a total return basis. But I was like, you don't hear a single bond investor pulling out their hair, talking about it, going crazy. And, and a lot of the bond indices, even like the ag and everything else, was down 20. And this is nominal. So real is even worse. And many of them 30 are still down quite a bit. But I was like, if stocks were down 30 to 50, people will be losing their minds, right? Like, but I was like, why is this curiosity? And people respond to me, they're like, well, I get my money back with bonds. And I was like, that is such a curious response. I'm like, what it's such a different mindset on how this all works.
Yeah, by the way, people have asked me about other asset classes. And I think certainly with real estate, where there is decent data, and I was thinking of your farmland that I know you sometimes discuss, and has got me, like basically those types of real assets, they are also primarily quoted on their past performance, and you can and discussed through that lens. And if there are serious studies, and again with housing markets, there is some good data. It certainly shows this type of extrapolative behavior by investors, that they don't primarily focus on valuations. They primarily focus on, hey, has it been hot? We expect more of the same. And so I think that's somehow supportive of my story here.
Switch gears a little bit when we're talking about portfolios. Now that we talk about bonds, and you kind of in the series talking about, at least in my mind, thinking when we get to the final number 10, you start talking about, and we can start maybe with I like exhibit 5 to start with. You're like, look, Even on a risk-adjusted basis, 60-40, despite how bonds have been, like, if you close your eyes, you don't tell anyone what the strategy is. You're like, wow, this has got a Sharpe ratio of 1. This is like got to be some killer hedge fund strategy. I'll pay 2 and 20 for this. You're like, no, just kidding. This is 60-40, right? But talk to us about, like, all right, we all know stocks are expensive. Diversifiers, for the most part, hadn't been additive, but hey, what is when you're doing 15% a year?
Really, like this is not yet showing the diversifiers, it's showing the benchmark. So the benchmark is on US 60-40. When 60-40 does well, like it did through 2010s, the Sharpe ratio was 1.3, 1.4, almost full point. So over the long run average of 0.4. And whenever such things happen, any kind of diversifiers, and the menu includes commodities or non-US markets or hedge funds or various long-short strategies and so on. All of these seemed like a drag then in that situation. And then it's somehow helpful to remind people that, there were pictures or periods in time such as 2009 and so on, when diversifiers were gracefully acknowledged just before they ended up starting their more difficult period. So I think that rear view mirror perspective is again dangerous in this front, and we may get to liquids versus illiquids because there are further stories to be told. But I think one thing I want to sort of take out from this one is that diversifiers have been especially difficult when you bring them in standalone, and we know this from experience that people then look at them too much at line items, and they don't think about the benefits they get from diversification perspective. So in that sense, some ideas that have been brought out recently, basically combining equity exposure with the diversifier alpha exposure, are particularly valuable. So I'm talking about portable alpha or return stacking or so on, where you don't get into this situation like in 2010s where people just bailed out of various diversifiers because they were maybe doing okay, but the bar was so high from the equity market beta. So I think the idea of putting together the equity beta through some equity derivatives which don't require much cash, using that cash to some diversifier, that's probably a more realistic way of bringing in diversifiers in a meaningful way. It's making a comeback now. I think there's much more potentially to go on that front, but that might be the more common way of bringing in diversifiers, the portfolios in the future.
As I like to call it, hiding broccoli in your pasta dish. I got an 8-year-old, so it's like, how do you sneak in these vegetables? And the vegetables to me are the diversifiers, and we can pop over to 10-4 for just a second, and then we'll pop over to 10-3 after this. But there's a whole menu. Listeners, it's not just U.S. stocks or nothing, or bonds or nothing. You got different sizes in the U.S., and small cap has been a stinker for a long time. You got non-U.S. emerging markets, which nobody wants. Both those up 30% this year. You got high yield bonds and commodities and hedge funds, and my favorite, trend. And we hop over to the trend one. Like all of these things, I think are a solid a veggie platter that we can hide with. A bunch of these protein cereals, not very good, but some of them, maybe.
Yeah, I don't know whether I'd like to contrast a little the liquid versus illiquid alternatives. Like there are several aspects of that. So basically, liquids, they are true diversifiers, whereas illiquids often have got lots of equity beta, whether it's sort of hidden. At least the slow beta is there. It's very clear when you look at like 3-year rolling returns of S&P and private equity indices, very closely moving. And so that true diversifier is a real benefit. But there are some things that sort of go against it. One is that they are, I think often these things are short on stories, or like there's not as good stories that we tell on some strategies, including trend following, but many of these, especially when you talk of multi-factor, then it's really, you have to be pretty statistically oriented to be able to convince investors about it, and they sound complex stories. Also, people think that these liquid strategies, that they are the black box, whereas I think it is the intransparency in privates, which is a bigger deal. And then there is, of course, the contrast that with liquid alts, you have got this honest mark to market, and you don't have that in many privates. And there is an interesting angle there. I do think that the smoothing feature, it helps patience. So I do think that there is an advantage that privates give for investors to basically to behave better. And that is valuable. But I do think that value is sort of offset by the fact that then investors have been piling onto those assets so much that collectively we probably bid away the illiquidity premium because of the good smoothing feature and the patience advantage. There's a lot of, I think, things to contrast these, but especially when it comes to diversification, I do get almost angry when I think of the diversification with those privates. And, we know that there is smoothing, but in addition, in many cases, institutions they report and maybe have to report the privates basically 1 quarter lagged because they don't have the data at the time when they have got public market data. So you are not looking at same quarter. So certainly the equity correlation with same quarter private equity is artificially low because of smoothing, but the correlation with previous quarters private equity is of course even lower. And what kind of silliness that is then to talk about that as it's well, some people call it accounting diversification, and that's what it is.
I could see Cliff getting angry. Antti, I can't see you getting angry. You're too nice of a guy to do that. But I hear you. I see these things. We'll see them. People call them out on Twitter and elsewhere where they say, hey, here's my strategy. It's got a 4 vol, and the funny thing is that you now have publicly tradable ETFs that are trying to be private equity replicators. And, some of these, it's not just not a 4 vol, or it's not even a 10 or 15 vol. It's like a 30 vol. So it's like, not even is it not stock-like, it's even worse on the flip side. But, I feel like we just need a nice fat bear market where CAPE goes back to 20 to clean out all the nonsense. And, then I don't think anybody will complain about the vol anymore at that point when you're down. But who knows? I don't know.
So deliberately focuses on that volatility laundering or the smoothing aspect. But I've also written about the sort of the expected return angles, which have been cautious on private equity. And they got especially cautious when the cost of leverage rose in 22, 23. And there was basically logically these kind of long-term real assets should get cheaper when the real riskless discount rate goes from like 10-year TIPS yield went from -1 to +2. And those the valuations of many privates didn't move. And then we've been sort of getting the slow drip of poor performance because there's not much activity happening when the prices seem to be a bit unrealistic out there. So I've been sometimes a little meanly summarizing the private equity, especially their situation like this, that the history really has been great for investors, but future looks bleaker, and we've been living that future for the last couple of years. And I don't think it's over yet, but that's a I
always scratch my head when I hear people start to talk about on Twitter and elsewhere. They're like, yeah, but the Fed's cutting rates. All the risk assets are going to go to the moon. And I was like, do you guys remember the last 3 times the Fed cut rates? Big time, I mean, multiple percentage points. I'm like, stocks, risk assets didn't do great in those. I was like, what are you guys talking about? 2 of those times they went down 50, and one of them they went down 20. I'm like, that's a dangerous assumption to make, that just because Fed's going down that, things are going to look good. I don't know.
Yeah, I think it would be also healthy for the long run wealth of some young investors now to see some meaningful bear markets because there's a bit of that, the taller they are, the harder they fall type of story that could be out there then in the next decade. I don't know when.
So for people listening to this, Antti, they want to put it all together. How do they think about, the rest of the 2020s? We got halfway through the decade. What's your thoughts on kind of where we stand today?
I do think that the main message is in some way from the rear view mirror is that the rear view mirror looks much too benign for overall market, especially for US and maybe tech. But tech, the AI story is, of course, that if I'm wrong on this, then it's because of AI. And then on liquid versus illiquid alternatives, I do think that this is basically the environment now, I think is better for the true diversifiers. And even, equity premium, looking at stocks versus bonds from starting yields in US, it is quite thin. It is not zero, but it is thin. So I'd be cautious on risky assets, more so probably on illiquids. But I also know I'm humble enough to know that any of these forecasts can be wrong, and we many of us know the story of Greenspan irrational exuberance in December 96, and then markets rallying another 3+ years, and so sort of cautious on the time, but I'm definitely leaning towards caution here with all of this.
Well, we just had a Fed chair just say stocks are a little expensive for the first time, I think, since Greenspan. So we might be getting some echoes. Maybe we got 3 more years. We'll see. It would be crazy to see. Antti, now that you put this to bed, you got your 10 papers, and listeners will link to all 10 of them. Maybe it comes a book at some point. What's on the horizon for you now? Now that you've put this to bed, what are you going to be thinking about the rest of the year? You just taking the year off going skiing, or you got some other things on your plate?
Yeah, I think I do like zooming out. So this is sort of maybe an age question, but also I just think markets sort of pull you in too much. And I try to think of these big picture questions, and something that I've written about, and I think I will be coming back related to trend. It's this that for any investor, I think a good question about their portfolio and risk management is, what's the biggest risk scenario out there that could really hurt us? And then is there something that could mitigate that? And to that natural question, which is very easy to communicate to any kind of board and so on, almost always the answer is some kind of equity bear market. And typically it's also this kind of persistent bear market, which we haven't really seen for a long time. But if that happens, we do know something that's going to help. It is trend-like strategies in that situation, just mechanically and historically, it's there. So I think that story is something that needs to be repeated in this situation. And yet, at the same time, And
the nice thing about trend that I think a lot of people gloss over, you just nailed I think to me, the most important feature, which is covering your butt on the left side, tail, when things are kind of going crazy and terrible. But, there's the additional feature of trend, I think, to a traditional portfolio is the potential right tail exposure to things they probably will not have an exposure to normally. So the standard U.S. portfolio is 60-40, all in on U.S. stocks and bonds. And then you'll have things like this year where gold's at 4,000, silver's, 50, on and on, coffee, who knows. So you'll get exposure to things that you may not have a normal exposure to. And that's mostly in an inflationary kind of type of environment. But for a lot of people, it can be additive in other times too. Anyway.
Yeah, and I do think a bit related to what you're saying is that trend and momentum strategies, they're obviously opposite in some sense to the value contrarian strategies, where you'll suffer if there's some structural change out there. But so given that the world has got some of these structural changes, it is good to have also then those trend momentum biases, and they take you, into the Mag 7s and into the US overweights and away from some of the things that you might like. So I think, again, balancing both of those things is helpful. But again, I think if I have to pick one sort of risk mitigating story there, and there are others, but I think trend type strategies, trend macro are my favorites still out there.
Ditto. You and I both. I made a joke because Cliff was on TV yesterday with a mustache, and I have an old post from many years ago where I say I have a theory that every portfolio manager has their best years and their mustache fades. So I said trend, and because the headline was trend, as I was going back to Bill Gross and PIMCO days, and I said the trend. This is a good contrary signal that trend is going to do great. Antti, this has been a blessing as always, getting to spend an hour with you and your Finland evening, about to release you into the northern lights. Get to go wander around the cold snow. It's still warm and hot here in Los Angeles. Thank you so much for joining us today.
Thanks. It was great.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.